Trading mistakes can cost you a fortune in the world of cryptocurrency, and to avoid such losses, you must give your complete attention to trading and stay focused. Remember, not everyone is cut out for trading, but the tips I'm about to reveal to you have been cemented in trading protocol, and when followed can help you succeed. So take note of what I'm about to share if keeping your investments safe is a priority for you. Before you even think about jumping into a trade position, make sure you know exactly why you're doing it and have a clear strategy in mind. Because here's the thing, not all traders are profitable. It's a zero-sum game, meaning that for every winner, there's a loser on the other side. But let's talk about the whales, the big players in the crypto game. They're the ones responsible for those huge blocks of hundreds of Bitcoins on the order book. And they're just waiting for little fish like us to make a mistake. So even if you're a daily trader, sometimes it's better to sit back and do nothing instead of exposing yourself to substantial losses. Remember, one of the most crucial things that you can learn as a trader is when not to trade. So take a deep breath and think before you make your next move. Trust me, it could be the difference between making a killing or getting wiped out. Now, if you're in a trading position, you need to set a clear target level for taking profits and a stop loss level for cutting losses. It's not just about making money, it's about protecting yourself from massive losses. But here's the thing, choosing the right stop loss level is crucial, and most traders fail because they get too attached to their position or the coin itself. They start thinking it will turn around any minute now, and before they know it, they're stuck in a losing trade. Let me tell you, in the world of crypto trading, things move fast. Extreme volatility is the name of the game, and a coin can easily dump by 80% in just a few hours, compared to the traditional stock market where just 2 to 3% can start people panicking. So, don't let your ego take control, and always remember to cut your losses before it's too late. Trust me, nobody wants to be the one left holding the bag. So set those target levels and stop loss levels and stick to them no matter what. Your wallet will thank you for it. Meet FOMO, otherwise known as the fear of missing out. Now, we've all been there, scrolling through our favorite trading app, and suddenly we see a coin that's being pumped like crazy. That bold green candle staring at us straight in the face, practically begging us to buy in. But hold up, don't get too excited just yet. Sure, it's possible that you could make a quick profit if you jump on the bandwagon, but remember, those whales we talked about earlier are waiting to take advantage of small buyers like us. When the price is high, it's usually the little fish holding onto those coins, and the next step is usually a big red candle selling through the whole order book. So, what should you do? Keep moving forward. Don't let FOMO control your decisions. Sure, you might miss out on a potential gain, but it's better to be safe than sorry. Stick to your trading plan and remember that there will always be another opportunity just around the corner. Trust me, as someone who's fallen victim to FOMO before, it's not worth the risk. Keep a level head and stay focused. Pigs get fat, hogs get slaughtered. And let me tell you, this statement couldn't be more true when it comes to profits. If you want to be a successful trader, you need to focus on small gains that will add up over time. It's not about trying to catch the biggest wave or the highest peak. Instead, it's about playing it safe and steady. One of the keys to managing risk wisely is to diversify your portfolio. Never put all your eggs in one basket, especially when it comes to non-liquid or high-risk markets. You don't want to end up like a hog, holding on to a losing position for too long and getting slaughtered in the end. Instead, assign greater tolerance to those high-risk positions and set your stop and target levels far from the buy-in level. This way, you'll be able to manage your risk effectively and avoid any potential disasters. Remember, it's not about making a quick buck. It's about building a sustainable and profitable trading strategy that will lead you to a long-term success. It's important to understand how the underlying asset can impact market volatility. Whether you're trading Bitcoin or altcoins, the smaller the market capitalization and trading volume, the riskier and more volatile the market can get. And let's face it, even Bitcoin is a wild ride compared to fiat currencies. In the past years, it was common for Bitcoin and altcoins to exhibit an inverse correlation, i.e., when Bitcoin rose, altcoins prices would fall against it, and vice versa. However, since 2018, the correlation has been unclear. Regardless, when Bitcoin is volatile, trading conditions are kind of foggy. During periods of fog, we can't see far ahead, so it's better to have close targets and stop losses set, or not to trade at all. Now, the fact that most altcoins lose value over time, don't let this discourage you from investing. They may bleed out slowly or rapidly, but the fact that the list of the largest 100 altcoins by market cap has changed so much over the past few years tells us a lot. Instead, be strategic with your choices and consider holding on to altcoins with high daily trading volumes and a strong community backing. It's important to keep an eye on the coin's chart and identify periods of stability and accumulation. Don't fall for the hype when a coin is pumping and everyone else is buying. As Warren Buffett once said, be fearful when others are greedy and greedy when others are fearful. Remember, the altcoins that survive in the long run are the ones with a solid foundation and positive project announcements. So, if you're building a long-term crypto portfolio, choose wisely and stay patient. The right time to buy into a position is when the coin is stable and the future looks bright. Alright, a quick word about public ICOs, which were later in 2019 replaced by initial exchange offerings, IEOs, and even later in 2021 were replaced by initial DEX offerings, IDOs. These are all crypto token sales, which in hindsight would have been a much simpler title, crypto token sales, CTSs. Now, many new projects choose to hold a crowd sale where they offer investors an early opportunity to buy a share of the project's tokens at what's meant to be a reasonably discounted price. The motivation for investors is that the token will get listed on the secondary market, i.e. the crypto exchanges, and yield a decent profit for early investors. In recent years, there have been many successful token sales with ROIs of 10 times, which were not uncommon. One example was the veteran prediction market, URGA, one of the first ever ICOs, which yielded investors a phenomenal 15 times return on investment when trading started mid-2016. Since then, many projects, including many IEOs conducted on Binance, yielded even higher returns. But what's the catch exactly? Well, not all such projects reward their investors. Many sales prove to be complete scams, and not only were they not traded at all, but some projects disappeared with the money, never to be heard from again. So, how do you know whether you should invest in a given token sale? A key factor is the amount of money the project aims to raise. A project which raises too little will probably not be able to develop a working product, provided they have no other funding, of course. While a project which raises a huge amount won't have enough investors left out there to buy the tokens on the secondary market. So remember to never put all your eggs in one basket and invest too much of your portfolio in one IEO, ICO, or IDO. Here are some potential tips you can start implementing immediately. 1. Reduce fees. Avoid making multiple trades and paying more fees. To save money, post a new order as a market maker, instead of buying from the order book as a taker. 2. Avoid pressure. Only trade when you have the optimal conditions to make the right decisions. Always have a trading plan and know when and how to exit the trade. Rushing and pressure can harm your trading game. Wait for the next opportunity. 3. Set targets. Always set your targets by placing sell orders. This way you can take advantage of price increases and reduced fees on the marker side. 4. Place low buy orders. Placing low buy orders can help you buy potential catch dips and even flash crash events. Be careful when placing low buy orders and monitor the market closely to avoid executing your buy order when the price is even lower. 5. Buy the rumor. Sell the news. Anticipate positive announcements, but be aware that the news may already be priced in. When the announcement is made, investors may realize their profits and sell. 6. Avoid FOMO. Don't rebuy after selling just because the coin runs up again. Take your profit and move on to your next trade. Don't chase FOMO or enter a position under pressure. 7. Leave your ego aside. Remember that the goal of trading is to profit. Don't waste time and money trying to prove yourself right. Focus on making more winning trades than losing ones. 8. Profit on the way down. Bear markets can be profitable. Learn how to short Bitcoin and other cryptocurrencies. Don't waste your time reading the news, because I think we can all agree the vast majority of the published analysis and news editorials you'll find in the traditional press are biased or promoted by a particular company or group. Instead, focus on learning about long-term trends through educational content, as this can be more useful in identifying investment opportunities. And remember, if something is already in the news, it's likely that others have already acted on it, so it may not be a profitable opportunity anymore. And don't get caught up in FOMO trades by listening to other traders' success stories, as this can lead to unhealthy competition. Concentrate on your own skills and strategies rather than blindly following recommendations from others. Have a long-term end goal. Now, altcoins are very tempting, but remember that the cryptocurrency world received an enormous amount of attention, which brought many scammers into the field. The idea that you are responsible for your funds, not the bank, is indeed revolutionary, but it can also lead to inexperienced participants sending their funds away, thinking about a high ROI or investing in an ICO or IEO that will change the world. Unlike traditional finance, cryptocurrency has no insurance. Once you send your funds, they're no longer yours. In the long term, only a few cryptocurrencies will survive. Looking at the top 20 coins ranked by market cap, you can easily see that beyond first place, which of course belongs to Bitcoin, most of the rest change from year to year. Since many won't survive, you need to think wisely about which altcoins to include in your long-term crypto portfolio and what percentage portion of your portfolio each of those altcoins will comprise. You can't time the market, as another crypto bubble could develop at any time. It's always crucial to keep track of the value of your cryptocurrency portfolio in terms of fiat currency, which is the everyday world's money, such as dollars or euros. However, it's important to remember that until the fiat reaches your bank account, you haven't truly cashed out, because cryptocurrency is not insured and lacking security measures can result in the loss of funds. Even successful traders are at risk. Some investors have lost their fiat holdings despite keeping them on exchanges after selling their crypto. The collapse of Mt. Gox in 2014 is the most well-known example of this, but the FTX fallout in 2022 could rival it as a major scandal. There's a lot of information associated with the crypto world, and things move very quickly. In order to stay up to date, find a reliable group of friends with whom to share trading ideas, as well as fundamental and technical data. Whether on Telegram or WhatsApp, chat groups contain members who are worth listening to, and of course others who you should be ignoring. And that's practically all you need to worry about when it comes to trading tips for cryptocurrencies. Remember, trading can be a challenging but rewarding experience and should be approached with a clear strategy, proper risk management, and a long-term perspective. Now, I hope you found these tips helpful, and if you have any questions or suggestions, feel free to leave them in the comments below, and don't forget to like and subscribe for more crypto-related content. Otherwise, I'll see you in the next video.